So we're going to go back to the Georgia life insurance exam. This is now chapter 3. The objectives for this chapter, upon the completion of this chapter, you will be able to define the terms endow, face amount, cash value, and rider. Identify the characteristics of term life insurance, identify the characteristics of whole life insurance, and list the characteristics of universal life insurance. Distinguish between variable and universal life insurance. So most of you, these are going to almost all be terms you may have heard before, but jumbled together and don't really have much of an idea. We're going to take their examples from this chapter, and then I'm going to give you real world examples. And hopefully these words will become meaningful to you. So one of the things to consider in all policies, is this for a short-term need or a long-term need? So does somebody need coverage just while their children are small, or are they looking to do for generational wealth creation where they need the insurance to be permanent? In other words, last until they die. So clearly if they have a 10-year term policy, that's not going to act. So a 10-year term policy is a policy that's good for a period of time, a period of 10 years. But if they want that to be generational wealth creation, then they have to guarantee that they're going to die within 10 years, which of course nobody wants to do. So then for like pure protection, God forbid, that's one type of insurance. And then the type that you want when you're going to use for retirement purposes and then for generational wealth purposes are different types. So depending on somebody's needs, we'll determine which type we suggest for them. How much coverage is needed? So if somebody needs $1 million of coverage and $1 million of permanent insurance is going to cost, say, $1,000 a month, and term insurance is going to cost $100 a month, and their budget is $100 a month, well, then clearly we're going to get the term insurance, and we're not going to just get them $100,000 of permanent insurance. We always solve for the need first. And then, of course, what it always comes down to is how much can they afford? So, okay, they need $1 million of insurance, but they can only afford 500,000 or 250. We're going to get as much as they can afford and then go a little bit under budget because we don't want anybody stressing themselves. One, because we don't want them stressed, but then also because if they lapse the policy, then we get a clawback and then we lose money. So that's not fun either. Do they need to get access to cash from this policy? And then what other types of benefits are they looking for? So the face amount is what you would call the death benefit. That's the amount of the life insurance. The cash value is what grows inside of the policy, income tax free. You're able to access it income tax free, and it passes on to the next generation income tax free. It's the only thing with triple free taxation in the IRS code. The death benefit. So the cash value continues to grow within the policy and will either be paid out as part of the death benefit or when the policy matures or endows. The policy matures / endows when the cash value in the policy equals the face amount of the policy and the insured is still living. This is typically designed to occur when the insured reaches age 100. Upon maturity or endowment, the entire face amount is paid to the owner and the policy contract ends. Riders are additional benefits to the policy that can be added. I recommend for all parents to add a child rider. On our term insurance, you can add $25,000 for every child for additional just $16 a month. There's a lot of the riders that we offer come for free. The living benefits riders, which pays out if somebody becomes critically, chronically, or terminally ill, are free. And then another benefit is if somebody is disabled and they can't work, there's another benefit that their premiums will be paid. That's a more expensive rider that I don't put on as much. But there are riders there, and we can look at the riders in each individual case to determine what the client needs. The face amount of insurance is also referred to as the cash value, the limit of liability, the maximum load amount, or the cash surrender value. So the face amount is also referred to as Anyone know? They're using tricky words here. So I think it's the limit of the liability to the insurance company. So that means that's the most amount that the life insurance company will have to pay out at that time. Let's see if I'm right. Yes, the face amount of insurance is the stated death benefit and is referred to as the insurer's, meaning the insurance company's, limit of liability, the most the policy will pay in the event of the insured's death. Term insurance is good for a period of time. It's pure insurance. It's pure death protection. If somebody doesn't die inside the 10 years, 15 years, 20 years, or 30 years, there's no money back. You're just happy that they're still alive. If they get sick during that period of time, we do pay out the living benefits. That's what you need to know about term insurance. Which of the following is not a feature of term life insurance? Limited duration, yes. Cash value, no. Pure protection, yes. Lower initial cost, yes. So sounds like it is B, right? Someone yell out so I know I'm not alone. B, there we go. Thank you. Term life insurance has no cash value and is often referred to as providing pure protection. Compared to the same face amount of whole life insurance, term will cost less. In fact, term will cost a lot less, which is why we always go for term insurance first. And if they have extra budget, then we start talking about permanent insurance, whole life insurance, universal life insurance, and other, shall we call it, more esoteric solutions. Types of policies are level premium, stays the same, decreasing premium. The death benefit decreases as well as the premiums. Increasing, so the death benefit might increase over the life of the policy while the premiums remain the same. Actually, for decreasing, the death benefit decreases, but the premiums remain level. Annually renewable term is the simplest form of term life insurance. It's the death benefit remains level, but the premiums increase each year. So ART, as it's called, annual or renewable term, the term renews every year, but every year it gets more expensive. The type of term, annual or renewable term that the company that we partner with offers is the price is equal to what you would have paid if you had a 10-year policy, but it starts off cheaper and it ends more expensive. A return of premium policy is a policy written as an increasing term policy and provides for an additional death benefit that equals a full refund of premiums if the insured is still living at the end of the term. These policies are very low risk with respect to paying benefits and therefore charge a much higher premium than level term insurance. So this is a policy that might say, okay, after 20 years, you can get some or all of the money back. So unlike term insurance, where if you don't die, you're just happy you don't die, this one you can actually get some or all of your premiums back if you don't die, if you decide you don't need any life insurance anymore. So it's like paying more for car insurance, but after 5 years, you get money back if your car is still in one piece. A quote unquote level term policy means that the blank remains the same throughout the entire policy period. Beneficiary, the cash value, the face amount, or the loan value. Anyone have a guess?
Cash value?
So a level term policy. So term policies don't have cash value. The beneficiary, you can change at any time.
Loan value.
Face amount. Oh, loan value. Jeez Louise.
No, the loan value, there is no loans with terms because there's no cash value, and loans come out of cash value. So the only correct answer would be face amount. The death benefit or face amount of insurance remains level throughout the term of the policy. Term policies do not have cash value or loan value. The beneficiary can be changed at any time. You can make the beneficiary your husband, and then make the beneficiary your child, and then your mother, and then your aunt, and then your sister. You can change it anytime you want. Special features. Renewable is a benefit that will renew the contract on the renewable date without evidence of insurability. And then convertible is the right to convert from one type of insurance, basically term insurance, to permanent insurance. So you could start with $100,000 of term that's very cheap, and then you could start to make more money. And then you could say, okay, I want to take 20,000 of that and convert it to permanent insurance. And then you could start to make more money. And then you could take 20,000 and convert it to permanent insurance. But as long as you convert it before the end of the term, you will never have to take another medical exam or anything. So this is why we encourage young people, even when they're single, no dependents, no nothing, get some amount of term insurance. Literally, it could be like $25 a month. They could get a whole bunch of insurance that no matter what their health status, they could get cancer in their 20s. They will have insurance for that period of time. So they could get a 30-year term policy in their 20s for really very little money, and they will have that insurance into their 50s. Who knows what someone's health could be in their 50s? I have sold insurance to a woman who was perfectly healthy, and then 3 years later came to me and said, "Oh my God, I'm so glad you convinced me to get that life insurance. I just was diagnosed with cancer." So luckily, she did survive. She does have children, but right now she would not be able to get insurance. Certainly not at the cost that she did then. So it was a good thing, and she appreciated that, certainly. And it makes you feel good when you realize you've done something good for somebody. So permanent insurance, there's a few different types. There's traditional whole life, which you might call the old style of life insurance. Basically, what happens is the insurance company takes your money, they invest it very conservatively, and they give you a rate of return in the range of 2, 3, 4%, and they try to make a little bit on top of that. And it's a very conservative investment. The returns are typically a little bit lower, and it's been around for a long, long time. And there are different ways to do it now. Some of them are better sometimes. Some of them are better in other times, but this is a type. Whole life insurance basically just means it's a permanent insurance policy that has a level premium and a level death benefit typically. You can also do a single premium life, but typically people are going to have a whole life insurance policy where they pay level premiums. Unlike term insurance, whole life cannot be convertible or renewable. Ordinary whole life, so there's straight life or continuous premium. This is the premium is level and payable to age, typically 100, or death of the insured, whichever comes first. Limited payment. Premium payments are for a specified time, for example, 20 pay life or 30 pay life, or they could be life paid up at 65, or it could be single premium life. So while the annual premium is higher with straight life, it is paid for a shorter period of time and will have a lower total premium outlay. So if you decide to pay for it for 5 years versus 50 years, the 5-year, or let's say 20 years versus 60 years, the 20-year pay is going to be less outlay over time, even though the death benefit will be the same. And then, as I said, there's a single premium. So sometimes you could just say, okay, here's $100,000, and you could immediately get $1 million of insurance. Obviously, there's some instances where that's a very advantageous thing. So a producer, which is us, a life insurance agent, is explaining the concept of limited pay life insurance to a 40-year-old client. When comparing a straight life policy with a 10-pay life policy, so the limited pay policy is the 10-pay life policy. So it's a limited period of time. So first, let's try to put these words together and understand the question. So now we're saying a producer is explaining a limited pay policy, which is this 10-pay policy, and they're comparing it with a straight life policy, which is one where you pay either until age 100 or until the person dies. Which of the following statements is correct? A straight life policy has immediate cash value. a cash value in a straight life policy will accumulate at a slower rate than the cash value at a 10-pay life. So we're looking for the correct answer. A policy fully paid up in 10 years will endow at the client's age of 50. A 10-pay life policy will have a lower annual premium than a straight life. So now there's a lot of confusing information here. So let's try to cut to the chase and pick the one we know is true. A, I'm not sure, right? It's a little confusing. C, confusing. Endow, I don't remember what that means. Age 50 doesn't quite sound right, but I'm not sure. D, so let's say a 10-pay policy where you pay it out sooner is going to have a lower annual premium than a premium that you pay for 50, 60, 70 years. No, that doesn't make sense. So now let's go to the only option left. Let's see if it makes sense. The cash value in a straight life policy will accumulate at a slower rate. So now they're double negativing us, whatever that phrase is. They're trying to confuse us, than the cash value in a 10-pay policy. So that means a 10-pay policy, we pay more money in and we start to accumulate cash value sooner. So that means the straight life is going to accumulate slower. So it sounds like B is right. Does anyone agree with me? Does anyone understand my logic, or is anyone completely and totally confused? I want to hear any of those answers.
Agree.
You agree? Anyone confused by what I'm saying? Because I know I just sort of threw a lot of words at you. And I want you to know that if you say you don't understand, that means I know you've been paying attention, and that's a good thing. So we'll see if it's B. Yeah. And it's right. So the actual amount of premium per year in a 10-pay life policy will be higher than the straight life since the number of payments is reduced. Because of this, the cash value will accumulate faster in a 10-pay life and slower in a straight life. So remember, straight life is typically pay until 100 or until the person dies. Straight, you could just consider straight, regular, normal, boring. If you know, again, there's some non-PC things that I help to remember. I don't encourage you to, well, I'm not even going to go there. So straight just means, in this case, regular. Figure the rest out yourself. Use the monikers in your mind that help you remember. Both policies will endow at age 100. Neither a straight life or a 10-pay life has immediate cash value. Neither do. Classify the following characters.
Just a question.
Oh, absolutely.
After you pay your first premium, then there's some small amount of cash value, isn't there, usually?
So let's see, is correct. Cash value straight life value will be at a slower rate. So at your first payment, there won't be. After the first year, there could be.
Okay.
But what they're saying is, like, if in the very first payment, like the first payment's going to be eaten up. I'll be very frank, with our commission. It's going to be eaten up by the cost of insurance, going to be eaten up by expenses. It's going to be eaten up by a whole bunch of things. Insurance is one of those things where you pay a lot up front, and then as you keep it, it gets cheaper and cheaper and cheaper and cheaper. And that's why we tell people, don't do this unless you can do this for the long haul. Don't do this if you're going to buy, don't buy a permanent policy and then get out of it in a year. We don't encourage that. We don't advise it. That answer your question?
Yes.
Now, there are some single pay policies. That's not one of these options. You put in a lump sum of money, then you will immediately have cash value because you immediately put a bunch of money in. In those instances, in the single pay policies, you will have immediate cash value and immediate death benefit. But again, they're trying to really, really trick us with this question. They're throwing a bunch of different factors in to make sure we understand what all of these different variables are. And so if we think, oh, wait, one of those things has immediate cash value, that's true, but it's not any of these. Okay, make sense?
Yes.
Perfect. Okay, so now classify the following characteristics as either term insurance or permanent insurance. Coverage may be renewable. Anyone want to shout out as we go down? If you know of any of these. So, for example, policy loans are available. Does anyone know where that? What is it?
Whole life?
Permanent.
Permanent. Right. So like term has no loans. Anyone else recognize anything?
I think the pure insurance is term.
Right. So now just look at the words. Permanent insurance, temporary protection. Where do we think this goes?
Term.
There we go. Exactly. Sometimes you just have to use logic. Sometimes it's a
Term
trick
can be
question.
convertible.
Which is convertible?
Term.
Convertible. Whereas coverage may be renewable, or maybe convertible term. Yep. Maybe renewable.
If it's
Any guess?
permanent, would it need to renew? So would that be term?
That's right. You wouldn't need to renew it. Exactly. Premiums may be payable for life, a limited period, or as a lump sum.
Wait, permanent for life. So that's term.
So
life.
Permanent.
Right, permanent.
Permanent. Yeah.
So now the word we want to use is permanent because there's different types of permanent insurance. Whole life is a type of permanent insurance. So we just want to understand the classifications so that we don't get, there's more options than whole life is what I'm saying. And there's actually now some better options. So written for a specified period or to a specified age. So for a period of time, that sounds very similar to a term, right? Okay. Issued with a level face amount. That's actually interesting. That could be either of them, but it's probably term. It has to be term. Well, it says maybe it means only issued with a level face amount.
Right.
So maybe it's issued with a level face. I don't know, actually. Let's go back to that. Death benefits may be level, decreasing, or increasing. That we know, that I know is term. So all of these must now be permanent. Issued with a level face amount. Designed to provide coverage for a lifetime. Yup, permanent. Premiums build a reserve known as cash value. We know that's not term. Policy matures or endows. And we immediately know that's permanent. When cash value, we know that's permanent, equals the face amount. We know that's permanent. Boom, great job. Non-traditional whole life, interest market sensitive. What is this? Current assumptions or interest sensitive whole life. This is a form of whole life in which the insurance company can change the premiums or interest rate based, being credited to the account based on current money market rates. Interest rates change affect the policy premiums. The policy has a guaranteed minimum death benefit, but may increase based on the growth of the cash value. Okay, so yeah, this is a type of cash value life insurance or a whole life insurance where the death benefit stays the same, but they have the option of raising the premiums on you. Doesn't sound like very exciting insurance to me, personally, but I assume there's a reason for it out there. We don't sell it. Let me know if you can hear this.
I don't hear it.
Nothing.
Rates increase, either the policy owner pays
Interest-sensitive
Now, can
whole
you
life
hear?
or current assumption whole
Yes.
life allows the insurance company to change the premium or interest rate being credited to the account based on current money market rates. Interest rate changes affect the policy premiums. The policy has a guaranteed minimum death benefit, but may increase based on the growth of the cash value. If current rates increase, either the policy owner pays a reduced premium or the cash value will increase at a faster rate. It is possible that the cash value will increase too quickly and could cause the policy to mature prior to age 100. To prevent this from happening, the insurer will add a corridor of insurance protection to keep the policy from endowing. This increase is provided without evidence of insurability.
So what that basically means, if the cash value increases too much, then what they'll do is they'll increase the amount of insurance. So instead of, you might start with 100,000, but then the cash value increases, so then they give you 110,000. You'll often see that in a policy over a period of time. So now universal life. I did not understand universal life when I was studying this. Now that I sell it and it's the primary thing I sell, I understand it, and the way they explain it in this thing makes no sense. So I'm just going to explain it how it really is. Universal life policy is something that has what's called a flexible premium and an adjustable face amount. So the insured can increase or decrease the face amount of the policy to say, okay, I'm going to start with 100,000, and let's say to keep 100,000, you have the option to pay anywhere from $50 to $100. If you pay $50, it might not last as long. If you pay $100, it'll last longer. But you also have the option to say, okay, well, now I want only 75,000. And so now I'm going to have less insurance, so I can also now pay less. So adjustable universal allows you sort of flexibility to allow it. Now, what we also do inside of this is we have something called indexing. Now, they're not really going to ask you about this on the test, but what indexing allows you to do is to tie it to an index like the S&P 500, or an index that we use called oh my gosh, it'll come to me in a second. Wow. I look at it every single day. Anyway, it ties it to an index where if that index does well, we get some of the gains. But if the index doesn't do as well, then we lose nothing. So if the index goes down, we gain 0.25. And if the index gains 20%, we might gain 17. When you look at this as a chart over time, you see that it is much, much better to ride a market, whether it's going up or down, with this indexing strategy. This is how the wealthy invest their money now. And so inside of life insurance policies, we can now invest it as well. So flexible premiums, it's going to ask you about option A and B. Option A pays the face amount of the policy and provides a level death benefit. Option B pays the face amount stated in the contract with a level term plus any cash value accumulated over the years. This provides for an increasing death benefit. So basically, A is a level death benefit, B is an increasing death benefit. Typically, we use one for kids and one for parents, but that's something we can get into when you actually have a policy to write. So non-traditional whole life, interest/market sensitive. Which of the following are characteristics of universal life policies? I see. So they were just calling it weird names. Okay. So I guess they're calling non-traditional whole life. Also, they're calling it universal. I see. So a fixed death benefit for life with premiums that may be increasing or decreased. So remember, universal, the death benefit can increase or decrease. 2 death benefit options, an adjustable death benefit and a flexible premiums. Didn't sound like that's what they said. An adjustable death benefit with premiums that are fixed for life, or 2 death benefit options with premiums fixed for life. Okay, so this, I guess I don't understand well enough because I don't know. Does anybody else know? So this, in these instances, what I do is guess. And then I read the question and the answer and then really try to understand it from this perspective instead of going back and reading 3 paragraphs or 2 pages. This tells me everything I need to know. An adjustable death benefit and then a flexible premium. Fixed death benefit for life with premiums that may be increased or decreased.
Is it A?
Maybe it's A. It's A or B. So I know it's A or B. So you said A, fixed death benefit for life with premiums they may be increased or decreased. Could be. Let's see. It was B. Okay. So which of the following are characteristics of universal life insurance policies? So my gut was a little bit better than yours. So my years, it led me to the right one. So now we're all going to know the answer. Universal life policies, there are 2 death benefit options. An adjustable death benefit, where the death benefit can go up or down. Oh, of course. Of course. Yes. So what this means in simple terms is you can adjust the death benefit up or down, and then you can adjust the premiums up or down. So that's what we know. So 2 death benefit options are key characteristics of all forms of universal life insurance. All universal life policies permit the policyholder to make changes in both the amount and timing of premium payments, including making no payments at all, providing flexible premiums, and the death benefit may be increased or decreased in accordance with the terms and provisions of the policy. So if you've paid into your universal policy for 20 years, and then you say, Uncle, I don't have any money, I'm not going to pay for the next year, you could adjust your premiums and adjust the death benefit to make sure that the policy stays in force. And then the next year you could win the lottery, or you could get a new job, or you could sell your home and get extra money. And then you could put it back into the policy and pick up where you left off and maybe even step forward. Index life. So they are going to mention index life. So this is what I'm saying is tied to an index similar to an S&P. So in exchange for the potential higher interest crediting, these policies offer a minimum interest rate guarantee, which could be 0%. The one we use is typically 0.25% to avoid cash value decreases due to negative index performance. What this means is your money is in there and it is locked in and it's not going to go down. So the question becomes, okay, well, what if the stock market goes down for 20 years straight? The cost of insurance is going to be greater than your premiums, and your life insurance is going to go away. But now let's think, if your money is invested in the stock market and the stock market goes down for 20 years straight, what's your stock portfolio going to be looking like? Like with 2 years down, we're in a world of trouble. 3 years down, we don't know what to do with ourselves. I don't know that we've even had a 4 years straight down in America. 20 years down, we're all like eating off of farms and I don't even know what our lives look like. Or we're all living off of cryptocurrency, one or the other. Either way, we're going to have land. We're going to be growing our own food. We're going to have cryptocurrency. We're going to have life insurance. We're going to have stocks, bonds, mutual funds, gold, businesses, entrepreneurship, real estate. We're going to have every single option out there. Whichever which way it goes, up, left, right, we're going to be okay, because we're going to have a diversified and a holistic approach, both to our finances and to our lives. So variable life. So an index policy is you're benchmarked against an index. So if the index does 10, you might get 8. If the index does negative 10, you're going to get 0. Variable policy, you put the money directly into the stock market. So if the stock market goes up 10, you gain 10. If the stock market goes down 10, you lose 10. It's just like investing in the stock market. there's not a reason to get variable life. There's not really a reason that I can think of at the moment for most people to get variable life. But that's what it is. It's something where the money is invested directly into the stock market. You also have to have a securities license to sell this, which means you have to have a Series 6 and 63 and be licensed with the Securities Exchange Commission. I don't have that license anymore. I used to because they have some rather stringent guidelines in terms of freedom of speech. You can't say this, you can't do that. I couldn't talk about cryptocurrency as freely as I do. So I'd rather not have it. You don't make that much money with it anyway. So the big money's in life insurance. So I'm just going to stick here. There's not a lot of, quite frankly, it's a lot of hassle and headache, in my opinion, when I had to deal with it. I just farm it off to somebody else, let them deal with it. So a blank policy has a death benefit that will increase or decrease over time based on the performance of the separate account, provides a guaranteed minimum death benefit, offers a choice of sub-accounts in which cash value may be allocated, and has fixed premiums. Fixed premiums. So, fixed premiums. So it's tied to a separate account. I think they're using funny language here. Because if it's a sub account, then I don't think it's the stock market. If it's an indexed account, so if it's a separate account, I don't think it's a variable account. My guess it's a universal life.
I guess A.
But I don't think it's indexed because that has a fixed premium. So wait a second, it can't be fixed premium because neither universal, no universal has a fixed premium. So it has to be variable. That's how we get to that conclusion. Universal is always a flexible premium by definition. So indexed life, I guess there could be indexed life that's not universal. So I guess it is A. Anyone else? What's anyone else's thought on this or logic? And when you're studying, this is literally what I want you to do. I want you to go through the thoughts. I want you to think about it. I want you to use logic, and then I want you to guess, but then focus on what the answer is they give. So of these, when they're starting to talk about separate accounts, a guaranteed, I think it's index life. We'll see. Let's see what it says. Wrong. Variable life. Okay, so now let's look at it. So a variable life policy has a death benefit that will increase or decrease over time based on the performance of the separate account, which is the variable account, which it is tied to, which it is invested in. So the separate account they mean is the account that the money is invested in, the variable, which is basically the stock market. It provides a guaranteed minimum death benefit and offers a choice of sub-accounts in which the cash value may be allocated. So you can choose, invest it in the S&P 500, or you can invest it in any other, variable mutual fund, you could say. And it has a fixed premium. So you could pay $100 a month, a minimum death benefit, but that death benefit and the cash value could increase, or that death benefit could stay the same and the cash value could never increase if the stock market doesn't increase. So that's variable in a nutshell. A little bit confusing. So that might be something you do some Google searching on or go back and read the section and get a little bit better understanding. That's what I would do. So I would get a little piece of paper at this point and say, okay, variable life, do some more reading and research so I get a better understanding of that.
Yeah. What I remember being told is that anytime you see variable, think stock market. So the reason why I was confused with this question is because it said it's based on the performance of another account. So I'm like, well, it didn't say an account that's in the stock market. So that's why I wasn't 100% sure. But I knew it wasn't either of the A or B. I knew it wasn't either of those. I knew it was variable, but I couldn't tell the difference. Or like it kind of tripped me up when it started talking about based on another account. But anyways, a rule of thumb that someone told me is that variable always has something to do with fluctuation of the stock market. Like,
right, exactly. And so now we understand that when they start talking about a separate account, what they're talking about is a separate account from their company, which is account run by somebody else, which would mean it's a mutual fund or it's a basket of actual things in the stock market that somebody's running. So it's a separate account from the general account, I think is the way they described it earlier. So make a note for variable and then make a note for double checking what general account means for universal. So we might do chapter 3 again, actually, tomorrow. So variable universal life. So variable universal life offers the added attraction of the investment components seen in variable life policies through the insurer's separate account, like universal life. The policy provides for flexible premiums and adjustable death benefits. Option A and B are available for policy owners. The entire cash value is held in the insurer's separate account, and the investment return fluctuates based on the performance of the separate account. Since all premiums are credited to a separate account, there is no guaranteed minimum death benefit. The owner bears all investment risk. The policy owner may take a policy loan or a partial withdrawal from the cash value without terminating the contract. A partial withdrawal is paid from the separate account policy, Policy loans are available based on the amount in the separate account. Typically, 75 to 90% of the cash value can be borrowed. All variable policies are subject to SEC regulation. So again, variable universal life is considered a security. It can only be sold by producers registered with FINRA and holding either a Series 6 or Series 7 registration. The securities registration is required in addition to a life insurance license. In some states, a variable contract insurance license and state securities regulation, Series 63, which is why I know about it in Mass, is also required. A prospectus must be provided prior to the sale of a variable policy, and there are suitability requirements that must be met before a variable policy can be sold. Now, a lot of people got really, really, really hurt by these policies. So imagine you're in an environment where the stock market is regularly doing 15%. So now somebody gives you an illustration and says, oh yeah, you can get 15% from this policy. And then the stock market does 5%. And then it does 10%. And then it does negative 10%. And then it does negative 5%. And it never gets back to 15%. But somewhere in there, you now took a loan. And now you need to pay back that loan. But you assume that you're going to pay back that loan based on an interest rate of 15%. But you might be only getting an interest rate of 5%. Now you owe more money than you can actually get out of the policy. I had an accountant who was tied up into one of these. He had to keep, basically, if he stopped paying the policy, he was going to owe tens of thousands of dollars in taxes because it was no longer going to be life insurance. And he took so many loans out of the policy that he didn't have enough cash value to pay the loans. He had to keep paying the premiums and wait until he died so that the life insurance would pay the loans off because the cash value wasn't enough. It's a little bit confusing, but just know variable can be really dangerous if the interest rate assumptions are too high. Because if you think you're going to get 15 and you get 5 and you have some negative years, it's going to be really, really hard. So what the insurance company has done is go, okay, that was a mistake. And so what they've continued to do is, okay, let's try to get something better and more secure, better and more secure. And so what they've ended up with is this index universal life policy, which sort of has a little bit of the best of all of the worlds. And, you know, when you see illustrations for that, we can show you how and why we think that. So whole life, death benefit, fixed, guaranteed minimum, cash value return is guaranteed, premiums are fixed, loans are available, the risk is in the insurer. Universal life, adjustable guaranteed minimum, cash value guaranteed minimum, premiums are flexible, loans and partial surrenders are available, risk is to the insurer. Variable life, variable guaranteed minimum, the cash value is not guaranteed, the premiums are fixed, the loans are available, the risk is with the policy owner. The variable universal life, variable and adjustable, no guaranteed minimal death benefit, cash value return rate is not guaranteed, premiums are flexible, loans and partial surrenders are available, the risk is to the policy owner. I don't know about you, but this seems like a hard sell to me. So I'd rather the risk be on the insurer than be on me. Thank you very much. Which of the following products requires a producer to obtain a securities registration in addition to an insurance license to solicit? One of you guys I know knows this. Variable, universal, indexed, or current assumption whole life. Which one requires a securities license, an SEC license to be able to sell securities?
Variable. Because
Variable.
Sunshine said, when you
That's
see
right.
variable, think stock.
Exactly. See, you learn something from her statement, and that's 100% true. Variable has to do with the stock market. If it has to do with the stock market, that's a security. You have to be registered. It takes additional licenses. If we don't get paid enough for that headache, that's it in a nutshell. That's it in a nutshell. All variable products are subject to SEC regulation and can only be sold by individuals with a life insurance license and a FINRA securities registration. Classify non-traditional, classify the following characteristics as either, oh, this is going to be fun, either universal life or variable life. Cash value in a separate account, fluctuations based on market conditions. Okay. Which one is that? Market conditions is the stock market.
Variable.
Variable, right. No guaranteed minimum return on cash value. No minimum return. So that means that the return could go up or down.
Variable.
Yeah.
Variable. Partial withdrawal or surrender available. Remember that chart we just saw? I think it was universal. Okay. So remember, if you have withdrawal and surrender between these two options, you've got, it's universal. I think you've also, well, yeah, universal. Sold by individuals with a life insurance license and a securities license. We now all know that is which one?
Variable.
Variable, right. Flexible premiums. We know that is with only one type of life insurance. Well, between these two. Universal, right. Policy owner bears all investment risk.
Variable.
Variable.
Variable, right. Over here it said, now we know this one. All right, so now we have a guaranteed minimum rate of return on cash value. So if this one has the investor and bears all risks, so this one must be
Universal.
universal. Fixed premiums, meaning the premiums cannot change.
Variable.
Variable. Death benefit varies along with performance in separate account.
Variable.
Yes, variable is when they start talking about these separate accounts. Adjustable face amount. Remember, what's adjustable with universal? The premium and the
Base amount.
base amount. 2 death benefit options to choose from, A and B,
Universal.
universal. And then the mortality charge for cost of pure insurance is deducted monthly. We didn't touch on that, but that's a characteristic of, I'm pretty sure, universal. So, right. So just understand that what that means is the cost of insurance is something that comes out on a monthly basis. So as you get older, the insurance gets more expensive, but you've also built up more cash value over time. So the idea is, as long as you are keeping up with the interest rate that's anticipated, you're going to be okay. It's if the stock market or the index that you're tied against, like I said, goes down for 20, 30, 40 years straight, you might not have insurance anymore. But again, if the stock market goes down for 20, 30, 40 years, like, our investments are gone. Like, there's so many other issues we have, which is why we need to be properly diversified and consider, as I call it, the portfolio of the 21st century. Combination plans and variations. So, now joint life and survivorship life. These are incredibly powerful policies if understood properly. So first, let's talk, we're going to read this because this is important. Joint life. So that means a husband and a wife together get a policy. And if the first one dies, then it's going to go to the second one. But they don't know who's going to die first. So it could be a husband and a wife together. Typically, they say the wife is going to die first. But because the husband and the wife are tied together, they might be able to get it, or they will get a cheaper premium. So let's see what it says. Joint life is a whole life policy that is written to cover 2 or more lives. The death benefit is paid upon the first insured to die, and the policy terminates. Premiums are paid based upon a joint issue age, which is obtained by an average of both insured's ages, resulting in a lower premium than 2 separate policies. This policy is designed to provide income protection for the surviving spouse when both have earned income. So husband and wife, husband dies, wife is going to get money at his death. It's going to be cheaper because they both got policies together. Now, second to die. In simple terms, they have a large estate tax problem. Husband can pass an unlimited amount of money to the wife, or they just have a reason that they are going to need money at the second death. So you could pass a large amount of money, husband to wife, but now wife to child, or mother to son, mother to daughter, mother to other generation, that's when taxes are involved. So now we've got to pay taxes. Life insurance becomes the saving grace for rich people in paying taxes. So this is a whole life policy, is usually written to cover 2 lives, and the death benefit is not paid until the last insured dies. Premiums are paid based upon a joint issue age, which is obtained by an average of both insured's ages, resulting in a lower premium than 2 separate policies. This policy is often purchased to provide a lump sum benefit to pay estate taxes once the second spouse dies. So I already said that we were going to continue with chapter 3 tomorrow. So we're going to answer this last question and end for tonight, because I do want to be respectful to your time. I definitely want to be respectful to Patricia's time, because we've been running literally all day. We went to pick up one of our daughters from camp today. Been in the car for, I don't even know, 4, 5, 6 hours. Did 2 hours in a fan base. Been working all day. So anyway, we're going to do this last one, and then we'll pick up at chapter 3 tomorrow. We'll jump through these questions, which we will have probably seen something similar. And then we're going to get to the questions at the end of the chapter. So now, a second to die policy would be the most appropriate recommendation for which of the following? Two business partners who are concerned about the future success of the business and want to provide funds to purchase the business from the descendant's family. So this is second to die, the descendant family. So if the first guy dies and the second person wants to buy it from the first, this is not going to help because the second person has to die. The first person has to die. So a husband and wife concerned about paying estate taxes after they have died. Oh, isn't that the exact example I used? So that might be true. So now let's see. A corporation concerned that its CEO might die before the end of his employment contract. That doesn't seem to fit because this doesn't fit. It has to be like a husband and wife situation or business partners, not like a CEO of a company. A business owner who wants to make sure his wife has enough money to buy the business from his partner if he should die before his partner does. This is called buy-sell agreement. And it's very powerful insurance. This I'm just going to mention very briefly. Let's say you are in business with your best friend. Best friend is your best friend. You love them to death, but you hate your best friend's husband. Let's say your best friend gets into a car accident and dies. You're now in business, if nothing was stated on paper, with your best friend's husband who you hate. This guy hates you. Now, this guy wants his money and he wants his money immediately. Well, guess what? You don't have any money. You have income from the business. So you say, well, how about we arrange something where I pay you, we're making $10,000 a month. I'll pay you $5,000 a month income out of this. And he says, no, I want to be done with you. Let's sell the business and whatever we come of it, we get. So the business might be worth $1 million, but there's nobody that wants to pay $1 million because they see the distress that these people are going under. So they have to do a fire sale on the business. Buy-sell insurance, if you have a business partner, is an absolute necessity. This is something we can go into every single business that has a business partner. We just say, hey, would you like to be in business with your business partner's husband or wife? And if they turn green, we've got a sale. So the only option that makes sense is a husband and wife are concerned about paying estate taxes after they have died. Be correct. This is why second to die policies exist. Married couple worried about estate taxes would be best served in most cases by a second to die or joint survivorship like policy. Estate tax problem in very simple terms. Let's say somebody's got a $20 million estate. They got, right now, the estate tax exemption is about $10 million. The estate tax is about 50% of the remaining. So if they have $20 million, then they're going to have a liability of $10 million. They're going to have an eligibility of $10 million. 50% of that is $5 million. So what you're asking of somebody who has, who you think is rich, you think is wealthy, they've got $20 million of assets. That could be $10 million in land, which they can't sell. It could be $5 million in a business, which they can't sell. And it could be $5 million in who knows what, which they can't sell. The IRS is going to come to them and say, guess what? I don't care whether you sell it or not. Give me $5 million. Smart rich people go, oh, sure. I planned for this. Here's my $5 million in life insurance that I might have paid $1 million for. Stupid rich people are going to go scramble and try to figure out how to sell their houses, their real estate, their business, and raise $5 million in a fire sale. If you find a rich family that has not done this, you're looking at making hundreds and hundreds and hundreds of thousands of dollars. And let me tell you something. There are a lot of Black families that have a net worth of $10 million. They're called football players, basketball players, and they don't necessarily have this set up. This is part of our target market. One sale could make you hundreds of thousands of dollars. So anyway, we'll get into this. We'll pick this up tomorrow in chapter 3. Any last minute comments or questions before we end for tonight? So just so you know, I'm going to be doing these, or rather, Circle Financials is going to be doing these every month, starting on the first Monday of the month. If you can make some of these, make what you can, download or get the software from. I will send the link in the chat. And do this on yourself. Do these classes on yourself. If you end up taking 2 months, if you just can't get to these and you can't get to the studying, make as many of the classes as you can. And then at the end, when we go through the whole exam together, see how you know. Like if you're like, oh my God, I still don't know any of this, take it another month. These are always going to be available. I've decided they're always going to be free. Next month, it may or may not be me doing it, but it's going to be somebody who's going to at least understand the concepts. And really, what you really need to do is be able to read the question and read the right answer. If you can do that and do it enough times so you get to the end of the chapter and you get the questions right, I promise you it works, because I've passed the life insurance exam twice using that strategy. Anything else? I did send the link in the chat. Thank you for showing up. And I will see you guys tomorrow night. Wednesday night's going to be product training. And then we're going to do Thursday night. And then Friday night is a day off. I typically don't work on Fridays, except for the Guap Coin meeting. So everyone have a great night, and I wish you all peace.
Good night. Thank you.
Good night.
Good night.
Night, thank you.
Peace.